Intuit stock, INTU, has lost nearly half of its value so far this year, plummeting. And yet you're looking at a business where management says, yeah, we're growing across the board. If you look at our global business solutions, QuickBooks, MailChimp, they're expecting teens type of growth. TurboTax, 8% growth. Credit Karma, teens. ProTax Solutions, various different tax brands, still able to eke out some sort of growth. Overall, a business the management thinks is still going to grow this year at a teens rate to around $20 billion plus in revenue. And yet the stock is plummeting. And this means if the underlying fundamentals are expanding rapidly, still at a good clip, I'd argue, 10% plus clip, this means the entirety of this drop, this huge, decline, nearly, over 40%, a little shy of 50%, is due to valuation compression, meaning the fundamentals are improving and fundamentals drive returns over time. But the valuation is what gets all this sort of noise, this heartburn in the short term, the ebullience, the excitement that you can get on day-to-day behavior. That's all valuation changes. And so then you might ask, well, why did the valuation change so much? Because you can see here, this is a price to free cash flow chart for Intuit, that it has gone from the stratosphere of around 40 to 50 times free cash flow, which is very rich, now to territory where a lot of investors would say, yeah, this is quite reasonable in a mid to high teens free cash flow multiple, around 16 times. And so it is important to take a step back. Why did this happen? And a big part of this is why you're seeing a decline in a lot of software companies, and now it's moving beyond software, which is the fear that AI is going to disrupt all of these businesses. And I think there is a real legitimate risk that AI will apply to most software companies. Now with Intuit, with all these different assets, you need to start going one segment at a time. And we're going to do that in this video to think about, okay, how much of an impact could it really be? Is it really going to attack this? And I really do think AI is going to be a revolution. So I think, when you're looking at one stock at a time and assessing what Elon Musk describes as I think he said a supersonic tsunami. That's this AI revolution because it's huge and it's happening fast. It's going to happen over the next few years, this huge impact. So I think you need to be very careful. Just this past week in my letter for my subscribers at Unrivaled Investing, I sort of walked through the potential safe harbors, the potential areas where you might be insulated from this dramatic AI revolution, but recognizing there's going to be tremendous disruption in the years ahead. I might do a whole separate video just focus on AI disruption, but I want to focus on Intuit, asking now, is it a bargain or where do I think it could potentially go in the years ahead? So as I mentioned a minute ago, there's a lot of data points suggesting, yeah, there's AI and new companies leveraging AI to potentially compete. Here's one altruist talking about AI-powered tax planning with Hazel, and they're working with independent advisors to offering new tax planning solutions. Once again, leveraging AI that says, hey, we can get your taxes done within minutes. Now, I don't necessarily think that this is the market that, let's say, is targeting TurboTax, for example. And then you might have some folks that say, AI is going to get so good. I'm just asking ChatGPT. And this is, one article from earlier where, someone's saying, hey, how do I go question by question and fill out the taxes myself? So, maybe that's my solution. So a lot of tax solutions, because a lot of folks are thinking, the tax code is so complex. Now you can have AI that memorizes it. You can memorize the local tax code. It can, the federal, and you can have this free or very low cost, super intelligent tax advisor working for you. So I do think there is this angle that a lot of folks are considering, and that's a big part of the reason why the stock is selling off. Another part is the concern and question of whether or not these new AI interfaces are going to be sort of the front door for a lot of consumer experience, where they say, this AI has become my agent for life, where I go, can you solve this problem for me? Maybe I need new auto insurance or a personal loan, or I want a new credit card, or I want, some sort of, financial, maybe home insurance. So there's a lot of different financial products that I might go searching for, and I might leverage an agent to do it for me. Because for something like, let's say, a personal loan, the different vectors that I'm going to bring to the table, let's say my own taste preferences, it doesn't really matter as much. It's about, well, what's the rate, what's the duration of the loan, and how much money could I get? And so you're not looking at a zillion factors like if you're going shopping for towels and you're like feeling it and getting a sense for it. With personal loans, how long, what's the rate, how much, ballpark. And when you think about Credit Karma, one of Intuit's assets, a lot of it is, this is a business model based on transactions where they're enabling consumers to go to their marketplace that has these third parties. And every time there's some sort of transaction on their marketplace, then you could, they get some sort of cut. That's the way to think about it. Well, if you have that AI that's the front door, do you still need something like Credit Karma? So for something like this, I would argue much more disruption risk. Taxes, it's a little bit murky. Something like Credit Karma, I'd put as high, as we think about this. But I think it is important to go, wait a second, not all business segments are treated, not all business segments should be treated equally. When you're looking at the global business solution segment, which is 60% of this business roughly, that is, talking about their QuickBooks. And that's this, accounting, payroll, payments solution that is going to be very, very sticky for small business solutions, for small businesses. Plus they offer MailChimp marketing and other small and medium-sized business tools. This is 60% of the business. This is very high quality, and I'd argue going to continue posting attractive growth in the years ahead. That's what I would think. It's hard to imagine AI, let's say, disrupting this source of truth, which is accounting. I mean, you might see some sort of change in the future, but so far I'd argue that's not really what the concern is. The concerns are around these other two segments, TurboTax around 0.25% of the business, and Credit Karma, which is over 10%. So it's really about this third of the business that I'd say has really much more elevated risk in the near term. Credit Karma, which I just talked about, where the AI becomes the front door, and then you're saying, well, wait a second, my transactions for new credit cards, new loans, new auto products, do I really need them? Versus having an AI that'll do the shopping for me and it'll go directly to the loan providers or the insurance providers. TurboTax, once again, that's getting a little bit murky. You're going to have some high-end solutions where you have the advisor plus the AI, but that's not really what TurboTax is talking about. TurboTax is the, helping the do-it-yourself sort of investor, the consumer tax preparation. So do-it-yourself plus assisted. I would strongly suspect this will come under pressure with AI solutions in the years ahead, either with new upstarts or folks, as I already mentioned, trying to leverage ChatGPT to do it themselves. The question is, well, how much of a headache is it worth it to still pay the price for TurboTax, and get this and get the sort of the stamp of approval that TurboTax brings, where it says, yeah, your risk of audit is this low. It's bringing in this proprietary data that, let's say, ChatGPT is not going to be able to bring to the table, because they could say, look, we're looking at all these tax filings. We can say with X% certainty, you're not likely to get audited. And even if you were, we would stand by this audit. We would stand by, this filing based on our doing this with you. And there is real intangible value to that folks might likely pay for over time. So I don't see TurboTax, let's say, getting disrupted overnight. This is going to play out over years, I would expect. Credit Karma, I do think, faces faster risk, faster disruption risk, more of that supersonic tsunami risk that Elon Musk is talking about. But once again, that's 10% of the business. And then you're looking at QuickBooks, and I'm thinking, that's, when you're talking about something like accounting, you want a source of truth. And then payroll. People need to get paid. You want to make sure it's done right. So you have these add-on solutions, payment, bill pay, and stuff like that. These are all critical things for running a business. I'd view that aspect of Intuit is very sticky. It's difficult to say AI is just going to replace that overnight. However, something like MailChimp and marketing, I do view, and that's one of the aspects of this global business solutions. So at least 60% of this business is very, very strong. But a third of it is, I'd argue, it's going to be facing real headwinds. And some folks might even say, Daniel, you're being too generous to the global business solutions segment. So then the question is, well, is it time to buy Intuit stock now that it's sold off so significantly? As always, none of this is financial advice. I'm just sharing a little bit about my own personal journey. Also, a quick plug, Abdul Rahman A wrote just last week, literally last week, a couple of days ago, he said, I learned so much from your process, how to upgrade my membership. How do I upgrade my membership to be a premium member? Because he wanted to join the community where I respond to questions and, folks can share their thoughts. This follows Joe R., who wrote, Daniel, thank you for all your insight. I've made almost $1 million following along with your investing journey. If you're looking for compelling ideas, come check out Unrivaled Investing. There's also Flash, where I'm one of the co-founders. We're leveraging AI. So AI is not only impacting taxes, but it's also, I'd argue, there's going to be a revolution with investing as well. And so you can check out Flash below. The link is free to use. Any company in the world, you're getting analysis. Plus, now we're offering a portfolio watch tool. So that way you can get a podcast on your portfolio. So it's an analysis of your portfolio, sort of the upside, downside, potential risks, potential new ideas. So I think there is this wave. You should ride the wave and try to figure out how it can benefit your personal journey. This is for paid subscribers at Flash. So see the link below. So as I think about Intuit, as subscribers know, I have a very straightforward checklist, this Unrivaled Investing checklist. And this is, it needs to pass it all in order for me to get comfortable. And the most important one is management alignment. And then I look at insider selling and I look at literally over $100 million, hundreds of millions of dollars in insider selling this past year, not really building a lot of confidence. I look at the fact that there's not a lot of strong ownership. The CEO, Goodarzi, has something like $100 million position, but it all came from the equity that he's gotten in the last few years. You can see last year, was effectively paid nearly $40 million. Yes, only $1 million was salary only. And yes, the cash incentive, the bonus was only another 2.6. So the vast majority of his compensation was tied to, equity related. But I still look at this and I still see that he sold, tens of millions of dollars just earlier this year. It's not really, it doesn't give me the good feelings that I'd want to see. And I've talked regularly on this channel that I like it when I have a sense that management has huge amounts of skin in the game, not just, hey, I've been the CEO for the last few years and I've been collecting these equity, coupons, and now I own $100 million worth of equity through restricted stock units and stuff like that. And I look at his track, his experience being with this company. He's been in leadership positions since I think around 2004. And I don't think there's been one insider buy in all this time. So think about that. Like, you have this company where you don't buy shares, even after a drop like this, there's no buying. I mean, that just is such a tell, such a signal. Look, if you really believe in your company, let's see the executive step up. You got a $3 million cash bonus. You've been selling tens of millions of dollars in stock. Let's see some of these executives buy some stock. Say, yeah, we believe in the journey ahead. If you do that, then I think it's easier for investors to want to get involved. But I don't just mean like a measly, hey, I bought $1 million. I want to see like the $10 million. Oh, I levered up. I want to see a CEO say, yeah, I'm borrowing money, $20 million to buy this stock. That sort of conviction. We are at the other opposite end. The other opposite end is hey, the stock seems pretty good. And by the way, I just sold $20 million. Like, okay, let me judge your actions. This isn't, you're not passing the management alignment when I think about the skin in the game. And that's also why I've talked about, I like founders. It's like, this is their baby, not the case with Intuit. So then the question is obvious growth. I see initiatives like they're talking about building here it is. They're talking about reinventing in-person tax filing nationwide. Then they muddy it up talking about how they're making a $100,000 donation to New York City public schools that has nothing to do with in-person tax filing. It just makes me like, I don't think a founder would do something like this. It sort of goes against the principles of what's going on here with this business. Is let's leverage AI to make this possible. Now they're talking about uniting AI and the human expertise to reinvent. Just doesn't scream out to me. It doesn't make me think, oh yeah, this is obvious growth potential. This is not the way when I'm thinking about it. Now this headline from November, I think, is kind of interesting. So the reason why I'm sharing this is when you have multiple different headlines, one can make you think, you know what, maybe, management, you don't want to bet on them. Or maybe you're just saying, doesn't scream out that they really understand how do I grow this business in the future? And it's more like the Warren Buffett comment that you want to own a business so good, even a bologna sandwich can run it or something like that. I think that was his nice vernacular. And I think Intuit up until this point has been the type of situation where you could have, some sort of person that's not heavily aligned sort of run the business. I think that's what you're looking at. But this is the challenge, which is as you're facing existential risks because of AI, that durability of the free cash flow has become less certain. Thus, the valuation multiple is contracting. That's how I started this video, talking about valuation contraction. So then the question is, well, how do you get back onto the path where you go, there's just obvious growth. And if there's obvious growth, the business is more likely to be durable. Hence, the valuation multiple re-expands. And this headline I thought was kind of interesting, which was they're partnering with Riemann to fuel mid-market business growth. And from my prior experience as a CFO, I helped a business grow, a payments company grow from around a couple $1 million in revenue to around $30-40 million in revenue over a couple of years. And we, during my time, we stripped out, we ripped out QuickBooks, we replaced it with a different solution. And a large part of the challenge that QuickBooks faces is that it is for smaller businesses. And so if you could leverage AI to build out all these features that make the mid and large companies go to the more expensive enterprise solutions. If Intuit could say, you know what, we're throwing down the gauntlet. We are now going to compete with the oracles of the world to build out these ERP solutions. And so that way, every time a small, company starts with QuickBooks, they're going to leverage us for payroll. They're going to leverage us for their financing solutions. And by the way, as they grow, we're prepared to address what they need. We can really make this much easier for financial planning and all sorts of solutions. So that does sort of entice me because they're saying, look, too often, for too long, the market for medium and large size businesses, it's been overserved by these legacy enterprise resource planning systems that are expensive, time consuming to install, costly to install. And look, maybe we could leverage either different apps or build it ourselves so that way we can now compete in this space. So this could turn into a growth driver for the business as they potentially move up market. And that is a very intriguing sort of development. I'm very curious if they're able to pull that off. When we look at their business, focusing on QuickBooks, which is, in my opinion, a very solid business, you can see last year, look, this is a business that's growing around 20%. This is fantastic. And when you're looking at, this is the global business solutions, and it's really split into their QuickBooks, which, as I already mentioned, is very sticky, and online services. So, online services is kind of nebulous. So that's all the sort of things that get added on to QuickBooks. So you might think of money offerings like payment processing, bill pay, maybe some sort of financing solution because they can see your financials. So they can say, hey, we can give you a loan that fits right in. Then you have some payroll solutions, and then you have marketing MailChimp's marketing automation. So that is all with these online services that is also growing really well. So I would say they're doing quite well in the online ecosystem for QuickBooks and the peripheral secondary sort of offerings. This is quite impressive. And that's why they're still able to post attractive growth in this critical segment. But as I've already mentioned, these other segments are a little tougher. When you think about the consumer segment, thinking about TurboTax, this is definitely going to be facing headwinds. So far, you haven't seen it. But I'd argue the impact from AI really isn't starting to show up yet. I think you are going to see pricing pressure here, and you are going to see the disruption in Credit Karma. This is in total about 30% of the business. Now, when I once again go back to Flash, my AI free to use analyst, it's saying the upside downside here is tremendous. It's saying 60% upside in the low case, 400% plus upside in the high case. This is very bullish AI assessment. And it's based on looking at management's guidance for this year in terms of their earnings. Now, this guidance alone is a little iffy because it includes stock-based compensation. So frankly, this is another example. You're probably picking up the vibe that I'm not crazy about management here with Intuit. And it's because, look, they should be traded. Doesn't everybody want to be a big boy someday, or big girl if, for the girls that are watching? It's a small percentage of my audience, but nevertheless, don't you want to be an adult? I think everybody wants to be an adult someday. No one wants to stay a kid. Powerless, parents are always telling you what to do. And in a big boy club, you wear big boy pants. And big boy pants say, you know what? We're not going to make up the numbers. We're not going to say, yeah, we're going to add back $2 billion of stock-based compensation. And that's what they're doing. They're still, it's amazing to me that you have a company that's generating real profits. They're generating around $17, $18 in earnings this year. That's what they're expecting. That is the real figure. The $23 figure, that's the difference between 18, 23. That difference is management saying, yeah, I'm going to wear my baby pants again. Put on some damn real pants and say, look, these are the actual earnings. This is the actual business. I'm not going to, make up and lie to you, the shareholder, and say, yeah, this stock-based compensation, it's not a real expense. It's a very real expense, and you still have a ridiculous amount of stock-based compensation. Wake up. Thank you for listening to that tirade. So looking at this, let's start with, this is once again, AI looking at the earnings, saying $23 in earnings. What sort of multiple do you get? What sort of growth rate over time? The low case is effectively assuming a 7%, high single digit growth rate over time. High case assumes high teens. Base case assumes low teens. And really, the part that gets tricky here is I think the AI itself isn't appropriately thinking. I'm going to dig on my own product here. With Flash, where I'm a co-founder, where I'm thinking the AI isn't being conservative enough to reflect on the potential disruption, in that if you don't have the obvious growth tailwinds that you've had, you're extremely unlikely to get a 35 times multiple in the future. So I throw this out the window. And then it's 18 times. Is that really appropriate for, this 23 times multiple or 23 times earnings when a lot of this is stock-based compensation? So given that a lot of this is stock-based compensation, maybe this should really be closer to 15 times. And what if 7% growth is closer to the base case that I would be thinking about versus a base case of, let's say, assuming 12% type of growth over time and a closer to 30%. So overall, I think AI here was a little too looking in the rearview mirror, saying, well, this is where the business has been in the past. Wouldn't surprise me if it's there in the future. And it's a little too tough for me. When I think about this business, it's trading around high teens, low 20s type of earnings multiple. And frankly, I don't have a good feel on what their growth looks like over the next 5 years. Maybe they're able to keep it up and keep growing around a teens level. Maybe they start facing real pressures in roughly a third of the business. And so while their global business solutions, 60% QuickBooks, is still able to grow at a good clip, everything else sort of stagnates, in which case maybe their growth rate is only closer to 5% over time. I'm also a lot less willing to think about that this business could be, let's say, 30 times or more over time. And so I think 15 to 25 times is a more conservative appraisal of this business, especially given the uncertainty of, hey, could AI and a true AI agent that's working for you disrupt part of this business in the future. So as I look at the upside downside, I view this type of thing where maybe over the next few years, it's closer to break even. And then, in a high case, you are closer to 100 to 200% upside. So it is pretty reasonable, I would say. I wouldn't say it's just crazy upside compelling. This is the type of situation where I would look at it and say, really, the tiebreaker needs to go to management. And do you love management? And I've already sort of given off the vibe that I'm not crazy about it. I would rather see something where overnight they buy $20 million and plus, it's founder led. And there's enough companies out there. There are thousands of companies out there that you can find the businesses where you're more confident that they have some sort of insulation from AI. And if anything, that there might be some sort of tailwinds that they can ride, even if there is tremendous disruption in the years ahead. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. My name is Daniel. You're watching Unrivaled Investing. Thanks so much for tuning in.